Welcome back, everyone, to Let's Talk Business episode number 5. And I am sitting here with Jeff Froman. He is our first guest today, and Jeff is a financial advisor and a certified financial planner with Thompson and Froman, and they are a financial advisory practice of Ameriprise Financial Services. Jeff, did I say that right?
You did. That's right. Great. Thanks for having me.
It's good to have you here. It's good to see you. I haven't seen you in a while, so I appreciate you coming on the show and joining us. Before we get into, and I'm going to talk about a lot of things today because our listeners and our viewers are always interested in wealth management tips and some retirement advice, which I know you're going to provide. But before we do, let me just hear about you for a second. How long have you been in this industry?
Wow. I started in the business in 2003, became appointed in February of 2004. So, gosh, pushing 20 years now.
Wow.
Kind of funny. Started out as an engineer.
Engineer.
Yeah.
You went from engineering to this.
Yeah, I have a master's degree in control systems analysis, if you can believe that.
Well, I'll tell you, let me tell you, it's hard for me to believe because I am not near smart enough to get a degree like that. When I was in school, a few buddies of mine had engineering degrees, and I cannot even fathom the amount of math that you need to know to become an engineer, but you did it, and
it wasn't much fun.
I can imagine that it would not be, and now look at you. You've been doing it for 20 years. So
yes,
if
sir.
You started in 03, 04, you were a few years ahead of 2008.
Yeah.
We know what happened then.
Yeah, that was scary for everybody. And the thing I think that I learned in that first big downturn was the clients that did the best were the ones that gutted it out
Yes.
and stayed invested.
Yes.
The ones that got scared and got out lost the most.
Right. I'm glad you said that. Let me say this. I'll give a little piece of an individual anecdote. My mother, who is no longer with us, she was going through what happened in 2008, and she was single mom and scared to death.
Oh, yeah.
That she was going to lose everything. Scared to death. And I kept telling her, stay, stay, stay. You sell now, you've lost that money. There's no getting it back.
Right.
But she was so scared that she ditched it. You know, she did what she should not have done, but there was no way for her to know that, and I felt sorry for her, and there's no way for anyone to know it. But it's the best advice, right?
Absolutely.
Stay still.
Absolutely. And we kind of saw that over the last, several years. We had the 2020 pullback for COVID. We had a big 35% dip in the market, but boy, it snapped back in less than 12 weeks. We were at new highs again.
Right.
And then again, just 2022, we had the highs in 21, which were probably a little overdone to begin with, but then a 35% pullback in the NASDAQ, almost 30 in the S&P 500. And we're recovering now, and I think it's probably going to take just a little bit longer to get back to those highs we were at in 21. So yeah, these are the cycles of the market.
Of course, and if you've been around a while, you see that kind of thing, and you yourself can be more comfortable with it. But what do you find with your clients? What percent? I'm just asking you to take a stab. What percent of your clients run for the hills, and how many of them know that hey, this is part of it?
None.
None run for the hills because you talk them out of it.
Most of my clients have been with me for quite some time, and we have these discussions on a regular basis. It's like we're investing according to the amount of risk they're willing to absorb.
Right.
So based on the risk profile, that's how we invest them, and their portfolios are going to move with the market based on how much risk they are willing to tolerate. I think I get more of, why aren't we up as much as the market is up? Well, you weren't talking to me about not being down as much as the market is down, several months ago.
Yeah.
But so you have to balance your willingness to take a loss against your greed. And for most of my clients, I think the conversation is around, what is our long-term goal? How do we get there? And is the investment strategy we're using going to get us there over the long run.
Right. So let's talk about what the market looks like today. Now, if we had looked at the market a year ago, it was kind of scary, right? Mm-hmm. Inflation was out of control, and it's been improving little by little, quarter by quarter. And so it looks much better today than it did a while back, even though we still have some work to do. But there is still volatility in the market.
Absolutely.
And there is still concern, and people still have cold feet. What are you seeing out there?
Actually, I think the biggest concern my clients have right now is still inflation. And then secondarily would be fear of a recession. So with inflation, while yes, inflation is moderating, we still have some factors within the economy that could bring that inflation back. Oil prices have been down, which means gas prices are down. Transportation cost is down. So that's been good for inflation. Recently, we're seeing those oil prices drift back up, so we could see some of that pressure reemerge. And then, of course, we have wage inflation. We just saw what happened with UPS, where there was a threat of a strike for better wages. So wage inflation has been a big issue, and that is usually the biggest driver for inflation. If you have to pay all of your employees more, then you have to raise the price of your goods more to cover that, and that's part of inflation. So the Fed has done a lot in the last year to fight inflation, and it's finally starting to take effect. Today, while we're talking, probably the Fed is going to raise interest rates another 25 basis points. Some believe that'll be the end of it. Our own investment research group thinks there's still quite a possibility of a second increase in the second half of the year here, probably before the end of the year. But we still see the end of the year being positive, even from where we're at now.
You know, I thought, well, there was a lot of talk that the last increase was going to be the last one. And so I was not aware that one was occurring as we speak.
Yes.
Did that come as a surprise to you?
No. Our chief economist, Russell Price, almost a year and a half ago, said that the Fed would push the Fed funds rate to between 5 and 5.5. Today we're at 5. After this increase, we'll be at 5.25. So that there's still room for another increase, according to our chief economist's prediction. And he's pretty darn good. He doesn't believe there's going to be a recession. He's like maybe 50-50, because we still may see negative GDP print on 1 or 2 quarters. But to have a technical recession, you have to see unemployment spike. And the jobs market in the U.S. is just so strong.
It is.
And so without that dislocation of employment, you really can't have a recession. So the consumer spending power will stay. What's happening is, because of interest rates, the ability for corporations to earn is coming back. I mean, earnings are down approximately 20% year over year in the S&P 500. And we're probably at the bottom of that earnings recession. And if we have a real recession in the real economy, it's usually the corporations that are bouncing up as the general economy is bottoming out. So we're probably in pretty good shape economically in the U.S. and market-wise.
Just a slight tangent. You mentioned the unemployment rate here in Greenville, although it is not back down to pre-COVID times, because we were talking 2.7%.
Oh, yeah.
I mean, historically good at that point. Even though it is not down there, it is still right around 3%, which is better than South Carolina and better by the nation as a whole by a good bit. But anyway, slight tangent there. Tell me, your investors right now, compare it for me to a few years ago, 3 or 4 years ago. Let's just say during the Trump administration. Okay, let's go back that far. What does their investment strategy on average look like today compared to 3 or 4 years ago? More conservative, I'm assuming, just because of the market, but tell me what you're seeing there.
I would say compared to 4 years ago, we're probably a little bit more conservative, and that was a shift we made in portfolios earlier this year when there was the threat of recession was higher. As we move through the summer, we'll probably get back to where our portfolios were 4 years ago. And the structure of the portfolio really doesn't change a whole lot. What I like to tell my clients is I don't make big bets. I make side bets. So we'll put overweight sectors in the economy. For instance, healthcare might be a good sector to rotate into at this point because it's generally a good recession hedge.
Right.
Everybody's got to go to the doctor at some point. So we just kind of tinker around the edges. Our objective is to achieve a return consistent with the amount of risk they're willing to take, net of my fees, of course.
Well, of course. We all have to make a living, right? Let's talk about small business, small business owners. Tell me how those guys are faring. And I ask that with more interest than usual since I'm a small business owner myself now, but tell me how they feel.
My small business owners, for the most part, their biggest concern is a possible recession and wages. For those employers that have a number of employees, and you have to pay those wages seem to be creeping up, which, of course, compresses your margins, the amount of money that you're, can make in your business. I think the other thing that for a lot of my business owners are single proprietors, probably like yourself. And their biggest concern is taxes. As we all know, in 2025, the Trump tax cuts for the middle class expire. So we have to go back to doing all of our, write-offs and figuring all that out. I have a CPA do that. It's like I always tell, as a CFP, I always tell my clients, I know enough about tax law to be dangerous.
Yeah, right.
So always talk to your CPA. But their biggest concern is, for those whose businesses are doing well, they're paying a lot of taxes, even now. And the fear of having to pay more taxes in the future, and how do we reduce the tax bill? And one of the best ways you can do that is by having a retirement plan. If you're a sole proprietor, or if you're a business owner with a lot of employees, or 3 or 4 employees, having a retirement plan that you can defer some of that compensation into and reduce your tax liability. And if you structure things correctly, if you're a very high earning business owner and say a sole proprietor, you can defer about $285,000 a year in a retirement plan if you structure it properly.
That is good information to know. And sticking on that for a second, I'm 57 years old.
Sure.
So I want to continue to do what I do for another decade or so. Other advice?
Gosh, you got to remember that even though you're only going to be working for another 10 years, you might be retired for another 30 or 35 after that.
Let's knock on some wood, but yes, you're right.
So, do you really want to become more conservative after you retire? If we look at this last year and a half with the inflation, clients, their money had to keep up with inflation, not just their spending habits, but their inflation, the inflation that was going on as well. So over the last, back in May, where inflation was, or not, a little further back than that, January, February, where inflation year over year was 9%. That means I had to produce 9% in returns for their portfolio to keep up with inflation.
Right.
Now, if they're in a moderate or a moderately conservative portfolio, it ain't happening.
Exactly.
But if we look at how we did over the past 10 years, if you remember way back in the day when inflation was running 1.5%, 2%, and I can produce 5, 6, 7% in returns, I was outperforming inflation for a very long time before this big spike. So we had a lot of returns banked for this spike in inflation, which is why you stay invested. Right. You stick with your plan.
Good stuff, Jeff. I'm going to get you out of here on this. Just one more thing, and it's about something that I know very little about, so I'm going to ask you just to bring me up to speed. Cryptocurrencies.
Oh, gosh. First of all, as an Ameriprise advisor, I cannot invest my clients in cryptocurrencies because they are unregulated, which means that nobody's watching out for you. Right. So, and that's why you see the wild swings in the prices. Now, by definition, a cryptocurrency is basically an invention by somebody who coded a bunch of stuff into the internet. I guess, my personal opinion and my fear for all the people investing in cryptocurrencies is what happens if they're regulated out of existence? Mm-hmm. China's done it. You can't have cryptocurrencies in China. There's a few other countries in the world who have outlawed cryptocurrencies. And ask yourself this question. Is the U.S. government ever going to give up their dominance of the dollar, cryptocurrencies? I don't think so.
Right.
So the cryptocurrencies have a utility, and mostly the blockchain underneath that tracks ownership of things. That's how the cryptocurrencies were designed. It tracks ownership of a object on the internet.
Well, before I asked you the question, my inclination was to steer clear, and now that I've heard your answer, my inclination is to steer clear doubly so. Jeff, that was good info, buddy.
I appreciate you having me. It was fun.
Man, I'm glad you were here. It was really good information. And but folks, I don't want you to go anywhere. That was Jeff Froman. He's the financial advisor and a certified financial planner with Thompson and Froman. They are an advisory practice of Ameriprise Financial Services. But like I say, don't go anywhere. We're only going to be gone for about 30 seconds, and we will be back with our next guest.